Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today, Dan interviews Joel Litman, founder of Altimetry Research.
And today, Corey and I will talk about, of course, the Fed meeting recently, but we'll also talk about ChatGPT and the new robot CEO.
Looking forward to that. And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. Okay, so we got to talk about the Fed because it's like an elephant in the room and everybody wonders about it and does it mean anything, et cetera, et cetera, et cetera. I think it kind of does mean something because I think Jerome Powell is crystal clear. He's finally beating it into people's heads. You know, don't think about cuts. We've got at least one more hike coming in 2023, maybe next year, higher for longer into 24 and 25. So just chill out.
Yes, it seems like to me, based on, the price action last week, that was reflected in the moves last week. Stocks had a rough week, bond yields up again, the dollar up again. So it's more of that same higher for longer story. If you look at the futures, the Fed funds futures, it's kind of, are pricing in 50 less basis point of hikes next year and pushing back the expectations for cuts the second half of next year. So that's to me what I saw happening off of that Fed meeting, which in and of itself, as I mentioned to you just before here, was a plate of hot garbage to me in terms of the messaging. It was just a mixed bag of messaging from what they were saying and then the projections that they put out, which was one of those quarterly meetings where they did projections. It was just a little confusing, as if, as we've come to expect here from the projections of the Fed. So,
the summary of economic projections,
right.
SEP. I've actually I read it once or twice in the past. I didn't read this one, and I don't read it anymore because I think for me, like the big enchilada is what's the monetary policy action? Staking, are they staying? Are they hiking? Are they cutting? And what's in that statement? I think the statement has a lot of information in it because it's uniform from meeting to meeting. So if anything changes in the statement, that means something,
Right.
I mean, they consistently, like every statement says we are devoted to getting inflation down to 2%. And I'm pretty sure that means PCE down to 2%. It's more than double that at the last reading. So that's important. If that disappears, or if it says, around 2% or just above 2%, that'd be a big change. So to me, SEP, Summary of Economic Projections, it's almost like something they're required to do, so they do it and they try to make it as nice as possible. It's just, it doesn't contain good information, I don't think.
Right. Yeah, I agree. Yeah, it's probably not worth the time hashing through it. I will say the two little things that I heard out of this Fed meeting or the press conference was, one, a little bit of Powell criticizing Congress / the Treasury Department about the reasons for higher bond yields. Basically he mentioned slightly the Treasury, the amount of treasuries that they've been issuing since the debt ceiling. He didn't say the debt ceiling since the debt ceiling deal, but since the debt ceiling deal. And in the past, he's totally avoided even like mentioning any influence of Congress or the White House on anything. I'm saying that because to me, it sounded like he was it felt like the Fed has done what it can do in terms of raising rates so quickly, and is maybe asking for a little help from here is what I was hearing. So that was interesting to me, just because
help a brother out.
Yeah, man. We're coming up on the political cycle, the election cycle and all of that. So I think it'll get a little more interesting as the year goes on there. But
all right, let's move on to this story that I caught, I saw it actually in the Financial Times first with, like, I follow a guy named Robin Wigglesworth. He's, sounds like something out of Harry Potter, but he's a real reporter at the Financial Times, and he's a good reporter. And he's covered this paper that came out in June by these 5 folks from various universities in Boston and one in Hong Kong. And the paper is called Executives versus Chatbots, Unmasking Insights Through Human AI Differences in Earnings Conference Q&A. Okay? So what they did was they took the introductory remarks, the earnings press release, and the financial statement data from a real earnings call, several of them, and fed it into like Chat GPT. Then they asked it the questions that were asked during the conference call to see what Chat GPT would say. And the ultimate finding, this was also reported on in some detail by Matt Levine at Bloomberg. The ultimate finding was basically there's 2 groups. There's like the one group that could essentially be replaced by ChatGPT because they're trying hard not to give you more information than they've already disclosed through the earnings release
Interesting.
and the financials and the introductory remarks, okay? And then there's another group whose executives during the Q&A gave more information. And that group, the stock went up or down more as a result of the call.
Okay.
Right?
Yeah.
So because they gave more information that wasn't contained. And they're the one that ChatGPT could not imitate, right? So Matt Levine came up with this conclusion. He says, so if your earnings are bad, you want ChatGPT to do it.
Right.
And if your earnings are good, you want to do it.
Yeah, that makes sense. Yeah. It reminds me of what's been my thought on, ChatGPT and this generative AI, like how could they replace, me as a writer, right, of words? I mean, yes, if I was just regurgitating data and had no insight or thought or creativity with it, yes. And so, yes, it could definitely replace me right now. But if you're thinking of, original ideas that aren't on the internet already, and or at least presented in a creative way, even if they are on the internet already, then no, you can't be replaced. And that's, to me, that's the CEOs who are saying more stuff and sending their stock either up or down. You could also, that could go for any job, right? You do something good or bad, but at least you can't be replaced, right? Because if the good part's valued more, at least somewhat.
Right. It's like there's a level of risk taking we do when we express ourselves.
Yeah.
And, if it's good, it gets rewarded. And if it's not, it gets punished in the sort of general marketplace of human interaction and ideas and the real marketplace of the stock market. So from there, I have to move on to this other story, which I can barely believe that it really happened. But I do believe it because I think it's ultimately a gimmick. But this Polish drinks company called Dictador, as in dictator, because they make tequila.
I got it.
Okay.
All right.
Or I'm sorry, they make rum. Sorry, they make rum, and rum is rum and tequila. I associate them with Latin American countries and I guess dictatorships and revolutions and things.
Right. Okay.
Okay. And apparently they do too in Poland. So it's kind of a
branding. Yeah.
So this company, Dictador, they hired a robot CEO and they actually signed a contract with it on I think it was August 30th. And it's a robot. It's a female robot named Mika. And
hey, Mika.
Mika, yeah. And she did a Reuters interview, and it's kind of creepy. I saw in the Reuters interview, she really just looks like a particularly lifelike child's doll, and her mouth doesn't really move with her words, and her hair kind of bounces the way a doll's hair does, not a human's hair, and it's just there's something really cheap and gimmicky about it. And she was originally hired to look for new customers and clients. I assume that meant distributors for the rum. And then she was tasked with finding designers to design fancy new bottles for their luxury rum products.
And this was all this was all over like video, or is it sending emails, or what's going on here?
Yeah, I mean, I don't know.
Okay.
Is she doing emails or conference call? I don't know. But she did a video interview. You can go on YouTube and find the video interview
Okay.
with Reuters that she did.
Wow.
And she's standing there talking, in her weird robot-y child's like doll way and saying, "I'm always on 24/7. I don't have a weekend. I'm always up to stir up some AI magic." But, the magic is not much if she's only got these 2 tasks to do, so I don't know. It's just creepy and weird, and the creepy weird part for me is this robot-looking woman with this dark outfit that already looks this is already sci-fi dystopia, and then it says right on the front, "Dictador." I mean, it's like it's straight out of, dystopian sci-fi. I'm like, boy, you guys, you need to read the room a little bit here. And she's awkward and just doll-like, and it's very weird.
Yeah.
Man.
So you don't think all of America's or the world CEOs are going to be replaced anytime soon? Mika and her friends?
Yeah, I think there are some whose jobs are definitely should be in danger for sure. You know, like I was talking about in our recent Stansberry Digest, I was talking about Adam Aaron, the CEO of AMC, and I was like, if I were on that board of directors, the minute before I resigned, and got the hell out of there, I would shoot off a memo that said, would ChatGPT have spent $28 million buying 22% of a shuttered gold mine that's never going to be worth jack squat? I don't know. Would Mika buy that gold mine? I don't know. I don't think she would.
It's hard to think she would have the imagination to do that, which would be, again, that's the bad part of human nature. That could be that you take with the good. The AI story, I obviously are talking a lot about it. Like there's so many, and these things are going to happen, with like the deep fakes with that I've seen just on the internet with people and good stuff with able to say things and produce videos in different languages and whatnot. There's that part of it. And then there's the other part that's going to confuse the hell out of people and trick them into all sorts of things, good, bad, whatever. Yeah, it's, AI is definitely here, it's, and the generative AI stuff is developing. I was talking to our friend Dave Lashman about this. He was talking to me about it. Apple's new chip in its next generation iPhone, like 17, I think it is. It's got a section on it devoted to AI. So you don't even need to, you just use the phone and it'll have the AI in the phone, in the chip. And so all kinds of stuff's going to happen in the next 10 years with AI, right. I think. The more I hear about it, the less I think with the stock stuff, it's a bubble. However, not so sure on that, but there's something to it, is my point.
Sure. I think AI is like, it's like the internet, right? It was that was a huge bubble. The dot-com bubble was really a bubble, but the internet, that doesn't mean the internet, it wasn't a huge development in human history, obviously, right? So, and, companies like Amazon and others just did really turn out to be that valuable, and then some, and then a lot more. So, yeah, I think AI will probably be the same way, right? We'll get a flurry of kind of garbage takes on it, and then that'll all crash, but it'll still be here, and it'll get better and better and better. And one day, like Mika will be real.
Yeah.
One day you'll actually want to hire her.
Yeah. And AMC definitely sounds like they could have used a little data dependent number crunching rather than what they've done the last 2 years or whatever it is.
Yeah. Or they could have used the sort of, conservative lack of imagination that you described. Oh, please, dear God, if we just could lack imagination and hang on to the money that we've raised from all these apes. All right,
I think we got somewhere there on AI. Not the Fed, but
I
AI.
think we did.
Yeah.
No, we'll never get anywhere at the Fed, but I think you're right. I think we agree, and you, and it's not just you and I, it's other folks at Stansberry too. AI is serious. It's here for the long term. And, if it turns out to be a sort of minor stock market bubble, oh well, deal with it.
Yep.
I don't know if our guest Joel Litman will have a lot to say about AI, but gosh, wouldn't it be fun if he did? Because he usually talks about very technical accounting issues, which sounds boring, but I promise you it's exciting. Nobody has the kind of focus on investing that Joel Litman has. And rather than, try to flesh that out, I think we should just talk with him so that I can prove to you that that is correct. So let's do it. Let's talk with our guest, Joel Litman. Let's do it right now. The Fed wants you to believe they've got inflation under control, but I believe we've only seen the beginning of a devastating new crisis. And if you don't prepare now, you could see your savings evaporate as inflation and interest rates soar even higher over the next 2 years. It all traces back to a golden thread that ties together the biggest financial calamities in America's history. But it seems the entire financial world is falling into this very same denial trap that led to massive devastation the last time this crisis played out. If you know your history, you know there will be winners and losers, and now is when you decide which one you'll be. I've spelled it all out in an urgent new report. Go to www.bankrun2023.com to get your free copy. I'll also show you how to get my complete playbook for navigating this crisis, including the 3 critical steps to take immediately. Again, that's www.bankrun2023.com for your free copy of my new report. Joel, welcome back to the show. Good to talk with you again.
Dan, thank you for having me. Great to be back on.
All right. So our listeners, let's bring our listeners up to speed on the two of us. I've been kind of consistently bearish for the last couple of years, but during that time, I've heard you strike a really bullish tone on more than one occasion, and you quite rightly, and I totally agree, refer to sometimes to the awesome power of the U.S. economic engine, among other factors, right? Among other factors. Had you wanting to be long and buy stocks, and I was, I would have, at the very same moment, I was telling people it was the top of the biggest financial mega bubble in all recorded history and all this stuff. So we've had a little bit of difference over the past couple of years. And that's worked out well for you, right? I mean, you made some good calls and your subscribers have made money, et cetera, right? I mean,
our track record has been very good. I'm happy to say, yeah. Long stocks and certain stocks, not just long the market, but specific stocks.
Right. So these days, though, you tell me you're coming around to my way of thinking.
Yes, sir.
I'm really super curious as to what in the world you could be seeing that brings you around to do that.
Yeah, it's the same thing that I saw in 2008, where I spoke in front of a CFA society in New York, and there are some of the biggest money managers and analysts and others in the room, and we started seeing some really big red flags at the time, and some of them that we'll be talking about, are credit related, and credit has been the canary in the coal mine for equities, and always has been, going back 150 years. Every major equity bear market has been preceded by a credit crisis of some kind. That's an important point. Preceded, right? Preceded. One of the reasons that we were so bullish in March, April, May, and June of 2020, while the economy was locking down, was that credit formation was unbelievably healthy, right? We felt that we wouldn't have widespread bankruptcies in the S&P 500. Now, people said, yeah, but there are bankruptcies in the economy. I said, well, there's a difference between buying the economy and buying the S&P 500, or the S&P 1500 even. And because of that, people are left confused, saying, how can the stock market be up? I'm like, because when the economy is in such trouble and there's closings, I'm like, yes, every mom and pop restaurant, is considering closing or going bankrupt, but man, did Domino's have a great year, right? And many, many other public listed companies that, were dine in and shifted to eat at home, work at home, play at home, and all those companies did very well. So that was because there was such good credit formation for that to allow it. Right now, we are seeing signals that scare the heck out of me, almost like 2008. We're seeing some heavy signals, and also sentiment. So at the early 2020, before the pandemic, we did have a market is expensive call. You and I aligned. We aligned. And we felt that the markets looked expensive at the beginning of 2020, but that wasn't because we weren't predicting shutdowns and a pandemic, lockup across the world. It was simply because we were seeing sentiment indicators that after 2019's 30% run or thereabouts, we were like, the beginning of 2020 looks really toppy. There's a lot more downside than upside. It was more of a sentiment and valuation call. That's sort of what we're seeing right now. So right now we have a similar to the beginning of 2020, more bad could happen than good sentiment and valuation being in the wrong directions for wanting to be long equities for the short term. But we also see some credit breakdown, which is more like 2008. So we almost get a combination of early 2020 red flags with early 2008, late 2007 red flags. That means it is not going to be a pretty 2024. We're very, very concerned.
Okay, as am I. Of course, it's nothing new with me.
Yeah.
It's new with you on this occasion. So it's hard not to talk about the fact that the Fed just had their meeting and they voted to keep rates unchanged and signaled maybe one more hike in 2023. And I believe the comment was higher for longer than most analysts expect in 24 and 25. So, it's funny to me, Joel, because I criticize the Fed sharply, heavily, a lot. But I have to say this about Jerome Powell. He's been very straightforward. He's told you exactly what he was thinking, and he's wanted to make it crystal clear all along the way. I remember what he said, we're not thinking about cutting at all. Like that's, because people keep asking about it. And finally, it seems like, he's starting to get through to people. Does the fact that rates are going to be higher for longer, does that weigh on your mind at all?
Yeah, Dan, as you know, we do, uniform accounting, so we don't accept the same price to earnings multiple that you'd see in Bloomberg or FactSet or on CNBC or whatever. We do our own calculation of it. And that calculation of that PE multiple for the US market is already pricing in a bunch of rate cuts. Meaning to get to the current valuations, based on uniform accounting, you need the rate cuts to happen. And that's just to make where we are now. So if we have no rate cuts or we have a rise in rate cuts, I think that's very bad for the market. And that's part of the reason we're saying the market is really toppy right now, frothy, if you want to use Seth Klarman's term, in terms of what we're seeing. Meanwhile, the earnings revisions keep coming down, despite where we see price to earnings multiples at these under uniform accounting again, at these peak levels. And sentiment based on whether you look at equity allocation or you look at market correlations, they're all lining up with this is the top of a market. So I'm not screaming that it's going to fall 40% next week, but I don't see it going up another 30% or 20% like it did in the first 7 months of the year. I don't think there's any chance of that really. And I think the Fed, because the Fed has a nice 1-2 punch combination. It's we want, good employment and we want to keep inflation down. Well, he's got good employment in spades. He's already solved that issue. So he only has to focus on one other thing, which is keep inflation down. And it's nowhere near as down as much as he'd like. And that means why not keep interest rates up to slow things down a bit? I don't see him cutting as much as market valuations are pricing in those cuts will happen. We see it holding, if not rising, which is frankly what he seems to be communicating.
That is interesting because we had Bob Elliott on the show from Unlimited Funds, formerly Bridgewater Associates, a guy, and who worked with Ray Dalio, and he was on Twitter saying, he had a similar viewpoint. He said earnings are going to have to grow like solid 10% in the next 2 years, each of the next 2 years, to justify this right here.
Yes, to justify current valuation in the face of earnings revisions down. Yeah.
And when I also look at it, like a year or two ago, Vitaly Katzenelson, a friend of mine who has also been on the show, portfolio manager, he was saying, look, just take the last 10 or 20 years or whatever it is and invert it. And one of the inversions that I feel like I'm seeing now, of course, one of the big inversions, of course, is interest rates, right? It was 0 from 08 to 15, and then again from 19 to early 20, or I'm sorry, from 0 again from 20 to early 22. So, we got all this 0% interest rates. There's no hurdle rate for investors, right? So it naturally encourages less risk aversion, right? People are just become naturally less risk averse because they want a return on their money. And I believe that the opposite happens when rates go to 5% and you can roll T-bills over, or 2 years or whatever it is that you want to buy, and get 5% on it. It creates a natural hurdle for investors, and it makes it a little more difficult. I feel like what we're adding up here are these forces that are weighing on really high valuations, and it's got to come down. I don't see the alligator jaw going the other way, with the bottom coming up and the growth coming up to meet the valuation. I don't see any of that.
And with the Fed continue raising rates, one of the things we do is we run, I'm a forensic accountant, but we also run forensic analysis on the actual audio of management teams when we're picking stocks or, building our do not buy list. We also run those audio forensics on Powell. And as you said, he is quite transparent. And even when we run those forensics, we're like, this does not sound like someone who is sandbagging or who really is going to lower rates. It sounds like someone who's still concerned deeply about inflation, is happy that unemployment is maybe where it's at, maybe even too good. And so his two green signals for keep rates high or keep raising are there versus, a 6 quarter straight rate cut, which seems to be what you'd need, right, to have the spur in earnings and growth to justify current valuations, as you were saying, Elliot was saying.
Yeah, and it's funny. I do that forensic stuff sounds really cool. What actually do you do? Like what do you analyze? What he's saying, or his tone of voice, or what?
Yeah, we studied years ago. We studied visual-based, body language detection. The problem is you can't get CEOs good video on that often. But thanks to Reg FD, you can always get good audio. There are some linguistic methods where you can look at word choice and word patterns. The problem is I've also done training for national investor relations, and I can tell you the investor relations people, the better ones, are definitely coaching their clients, or their CEOs and CFOs on which words to use. So the linguistic word choice, we think, has sometimes been, weeded out. We can't use body language so we can get good video, but the audio under wonderful Reg FD, Regulation Fair Disclosure, we can always get audio of management's calls. And with that, we run a number of voice stress and voice audio tests. We've done more than, I think, 40, 50,000 earnings calls. We've been running the Fed. We'll run the ECB when they talk about things. And it does give us insights on things like interest rates, as well as, specific companies. One of the things we found, people will say, oh, so you're running basically a lie detector. And I said, yes, but we're also running a truth detector, meaning we're looking for deception, but we're also looking for confidence. And the point that you're just making is when you listen to these calls and listen with that kind of technology, what's scarier sometimes is people have reasons to be deceptive because maybe Powell doesn't want to tell something or doesn't want to tell what he's thinking. But when he's confident about certain issues, like when he's confident that he's concerned about inflation, you walk away going, he's really concerned about inflation. This is not just saying it for the benefit of, trying to manage or manipulate expectations. He really is concerned because we actually see it's a confidence marker that comes through when someone is speaking with that level of conviction.
Yep.
And we go, all right, though, that means rates, if anything, things might change in the next 3 months. But if things are more similar, then we see him being more worried about both inflation and, frankly, very, very strong employment, very, very low unemployment. And that means raising rates.
Right.
Or at least keeping them the same. At least,
yep. And keeping them the same is like, I do a primitive version of this. I just take the statement that he reads. It's like 16 sentences, and I rate each sentence dovish, hawkish, or neutral. As much to see if I can rate it dovish or hawkish as anything. And, it's turned out like 56% hawkish like the last few times. And what I note is that like the 2% target just comes up again and again. It was 3 times. There were 3 separate mentions. 16 sentences, 3 separate mentions of the 2% target. Like they're devoted. It's almost like they're saying, we are going to hit this 2% target if there is rioting in the streets of every large American city and they're selling White House furniture to pay the bills. You know what I'm saying? We're going to hit this 2%.
Come heck or high water.
Yes.
Yeah. Right.
I mean, it's a standard thing. Like the folks at the Fed are essentially a bunch of academics, right, who got jobs with the government, and how they are. They're slavishly devoted to their target, and I just feel like, wow, we're going to see the target. We'll hit the target, but we'll be waving at it, driving 60 miles an hour in the other direction towards 1 and 0, right?
Well, they're still better than the Financial Accounting Standards Board, but I'm in agreement with you directionally.
Right. Oh, the FASB is bad, is worse than the Fed.
I mean, George Stigler talked about regulatory capture, 40-something years ago, and he said regulatory capture favors the incumbents, and it can be seen by signals like revolving doors and whatever. And one of the reasons we don't trust a PE that comes from as reported statements filed based on the FASB's GAAP accounting, which the SEC just simply approves, right? They don't go in and change anything. You've got a board of unelected officials, the 7 FASB board members who make more than $1 million a year. Each one, it's a 7-year contract. So any FASB board member, look, I was an accountant. What on earth are you doing that guarantees a $7.5 million contract over 7 years? These are unelected officials. So if they do something that people disagree with in the accounting, you can't vote them out. And so you say, where do they come from? They come from a board of trustees who make $150,000 to $200,000 a year of the Financial Accounting Foundation, which no one even understands, right? Who then appoint these 7 FASB members. Well, who do you think appoints those trustees? Members and the heads of the AICPA and the American Accounting Association. So lo and behold, the former head of the AICPA, who helped in voting in the trustees, then leaves the AICPA and becomes the head board member of the FASB. Does that not sound like George Stigler regulatory capture, revolving doors between quote unquote commercial interests and the regulatory interests? And so when people wonder why is the accounting so messed up, I'm like, well, who's watching the Watchmen? Imagine what the casino industry would be like if the casinos regulated themselves. Well, why would you think the accountants? Because they're nicer people? All right, maybe they're not as aggressive, but human bias kicks in. And this is one of the reasons we have to do uniform accounting on the market, on macro, and every other company, that if you're using GAAP accounting and you don't even know where it's coming from, and then you realize, well, no wonder it's so messed up, because the more complex and obtuse and difficult the accounting, the more you ensure the job of every accountant, which is what regulatory capture is, right? And so you're down to 4 accounting firms, 4, right? Big 4 accounting firms. Really, you don't have a lot of choice if you're a public listed company. You could go with a couple of the others, and there's good firms below that, but most of them go with the big 4. And when you look at the revolving door between the accounting firms and the AICPA and then the FASB, it is as people talk about pharma and the FDA having a revolving door. You've never seen this. You've never seen this. I mean, it is amazing in terms of these payouts, $7.5 million over 7 years. To do what? And I've been in that building. It's not like people are working until 60 hours, 60 hours a week trying to come up with the right accounting. It is unbelievably academic. So I don't know, when you brought up the Fed, I was like, yeah, it's still not as bad as the Financial Accounting Standards Board, which is why uniform accounting is so necessary, because you cannot trust GAAP accounting. You just can't. It's a mess. It's a colossal mess.
I remember years ago, I went down to Austin, Texas at a meeting of investors who were clients of a guy named Arnold Vandenberg, who was really sensitive to account. Yeah, he was sensitive to accounting issues. Yeah. Oh, yeah. One of the all-time greats. And Vandenberg said, look, if he said, I forget how he put it. It's been years ago, so forgive me for not knowing exactly what he said, but it was something like, if you did real accounting, S&P 500 earnings would drop 10% in a heartbeat. Like it would, he said,
yeah,
you can't trust any of it. And he had like 4 or 5 things listed on the slide that I can't remember, but it amounted to earnings are not anything like, what you think they are due to accounting issues. And this was 20 some years ago.
Well, all the followers of Graham and Dodd and Ben Graham, which basically means the CAF Institute, and any of the greatest investors, Buffett, Klarman, right? I'd say Marty Whitman in that list. They all repeat what Graham said, and Graham was, reported earnings, he said, is readily understated or overstated, and you're going to need to adjust it. So, I mean, that's going back to the fundamental Bible of investing, Intelligent Investor, and the security analysis, the Bibles, if you will, by Ben Graham, right, the Graham and Dodd, and Vandenberg, who I'd say follows in similar footsteps. Why would he? I mean, how many times has Buffett railed on accounting? I think 8 of the last 10 shareholder meetings.
Right.
He opened up talking about, don't ask me about my GAAP accounting numbers.
Yeah.
I'll talk operating earnings, I'll talk others, but I'm not going to talk about the bottom line because it's capricious, it's moody, and people pay attention, right? Because you look at Berkshire Hathaway, their quarterly numbers swing between negative 40 billion and positive 30 billion in profits or losses every single quarter. And it's because how bad the accounting is. It's not because Buffett's suddenly doing a bad job and a good job and a bad job and a good job. It's accounting that makes it swing so much. And that's what uniform accounting is necessary for, not just for individual companies, but when you're looking at a sector, or obviously when you're looking at the market as a whole. And when you put that together right now, the market looks awfully expensive.
Awfully expensive. Can you put a number on it for me, or like a multiple of?
Yeah, it's I'd say on a uniform accounting basis, it's something like 24 times. But relative to history and relative to similar interest rate environments, meaning we can go back 150 years, we can go back 130 years or so, and we could say, what are U.S. market multiples relative to where interest rates are? Not surprisingly, low inflation, low interest rates, you see higher multiples. Higher inflation, higher interest rates, you see lower multiples. If you say we're now going into a higher interest rate and definitely a higher inflation environment than we've been for the last 20 years or so, then that 24 times is not only expensive, it's very expensive, right? I mean, if it was like Bush tax cuts of 15% capital gains and 15% dividends, where you basically get taxed almost nothing, right? And so 97, 99, you'd say, 28 times multiple? That's crazy to say, but it's actually reasonable in 97, 98, 99, right? Because you had such low inflation, such low tax rates and whatever. But in this environment, with, if people would, I think, agree, we have rising taxes, not falling taxes. Then on top of that, you put in higher inflation and higher rates. 24 times suddenly in that context looks very expensive, not just relative to history, but relative to context. And I think that's what the market sometimes is late in getting.
Okay, folks, that's not me talking. That's Joel. Okay? He's the one telling you it's very expensive. Not just expensive, very expensive.
Now, there's a part of the problem is, though, that people don't want to, bonds are not a great place to put your money. Cash is a terrible place to put your money. And so even treasuries, relative inflation may not be the best place to put your money. And so we think for that reason, and if you go around the world, China is definitely not a place to put your money. You can't put your money in Russia or that area. So you're kind of left with U.S. equities if you do have an equity portfolio. And that may be why we see what I'd argue is an over-allocation to equities right now, which when you look at investor allocation surveys, where they ask the biggest active investors about their allocation, that is also at a many, many year peak level in terms of sentiment and being over-allocated equities at this moment, meaning as we're speaking right now. That is a scary sentiment indicator for me. It really is, because where's the upside, right? If anything, it means the market goes sideways, but more likely sideways, and then something happens and the market tanks. It's scaring me right now. Now, look, I'm a giant believer in the U.S. economy. If someone says to me, I got my money in a 401k, I'm not going to touch it for 20 years. I'm like, just let it ride. Let it ride, right? Ride it out. Because the problem is, if they sell now, what's the chances they're going to get back in 2 years from now? All those people that sold in 2008 did not get back in 2009, and they missed out on one of the biggest bull markets in history. And so if you're in it for 10, 20 years, I'm unbelievably bullish about the U.S. stock market. But if you need your money in the next 2 to 5 years, you cannot have your money in U.S. equities, period. End of story. If you need your money, if you're going to take it out in the next 2 to 5 years, it cannot be in U.S. equities. It doesn't make sense from a risk-reward standpoint. It just doesn't make sense.
Again, not me talking. That's Joel talking. Wow. So that's, I almost feel like we should end there because that was such a dramatic statement.
Well,
can't have your money in U.S. equities.
The obvious next question is, okay, then what do you do? Right. And
sure.
We've got this program Wednesday, September 27th at 8 p.m.
Mhm.
And me, our director of research, Amy, we're getting together and we're going to talk about some specific signals. We're going to show the actual charts. We're going to talk and walk through why it looks so scary and actually, walk through chart by chart details. And then, we're going to talk about the strategy that we see. I think, 230 or 240 of the biggest 300 money managers in the world are using our work. They want us to do the uniform accounting. They don't have to do it themselves. They want to use our earnings call forensics because they don't have that technology or that capability. So we have that, and we get to see some of the greatest investors, and we see a strategy that they're lining up for. And believe it or not, we are seeing a lot of money lining up in a particular strategy in the credit markets. And it's not just buying bond funds, because bond funds will do bad in a recession, also bankruptcy risk and whatever, but a specific type of credit. And we're actually going to walk through what we see some of our greatest, best clients lining up. And I'm saying literally billions of dollars to move into this particular credit strategy. And we're going to walk through that also on Wednesday at 8 p.m., September 27.
Oh, I got to tune in for that. I got to find out what that is. I know you can't tell me because
it'll be fun.
Yeah, you want to do it in the presentation, but yeah.
Well, I'm big on Reg FD. If we're gonna tell our clients, we should tell them all at once, right? And so we announce it. We tell everyone. We're all going to tell everyone at once the exact same thing, so that they understand. So we're also not front running or allowing them to front run. So I'd rather say, yeah, we'll tell everyone after that. If you want to wait, that's fine, but at least people know ahead of time what we're doing from a asset allocation strategy standpoint.
All right, and you're doing these strategies through like you're published. You and I are published basically by the same people. We're sort of all under the same umbrella. And what
Yes.
are you?
Yeah.
So you're publishing this same advice in what publication?
So Altimetry is our flagship publication. Altimetry is our flagship brand, and Altimetry, we're launching a newsletter, which is a newsletter and a strategy with specific recommendations for a credit-based strategy, which historically has done very well. I'm saying, we have stock picks that'll do 100% or 200% returns. You're not going to get that, not in the market we're coming into. But we can show 10% to 25% plus with very, very low risk going into this kind of market. It doesn't work as well, actually, if you're in a raging bull market, this kind of credit strategy. But it does work very well during these periods of time. And so for the next 24 to 36 months, maybe more, maybe a little less, right? Who can predict that? But going into what we're seeing and that kind of trend, why take the risk? And even if the equity is going sideways, why take the risk if you can really lock in 10 to 25% gains, not in bond funds, but particular credits? And that's what this new publication is all about. And that's what we're going to launch all at once.
Okay.
So all our clients and readers and subscribers hear it at once versus anybody getting a jump. And that'll be Wednesday night at 8 p.m.
Okay, and if listeners are interested, and you should be, I certainly am, you can go to crashalert2023.com and sign up for that, and they'll tell you, when the event is happening, and you can tune in and find out everything that Joel's talking about with this credit strategy, which is really, I'm starting to like scratch my head and say, what is he talking about? And I've got a number of thoughts, but I'll keep them to myself. So crashalert2023.com.
Well, I can give you a hint. I mean,
All right.
Do you think Moody's, S&P, and Fitch are doing uniform accounting when they do credit analysis? They weren't doing it in 2008.
No.
Right? They weren't doing it in go 10 years back from that.
Yeah.
So what's to believe that suddenly they got religion and they're doing, credit research that's reliable, right? Corporate credit, right? Anyway, and so just a hint, but yeah, it's in many cases because we can actually do credit analysis using uniform accounting and see, frankly, big differences and build a strategy around that. And by the way, we're not the only ones. And I'll actually mention some of the big investors that we see piling money into these kinds of strategies. And I'll talk about that also on if you join crashalert2023.com and register there. It'll be a fun event.
Yeah. Oh, I'm sure it will. Joel's events are great, charts, lots of data, lots of great information, I guess is just the easy way to say it. And it's
Thank
just,
you,
well,
Dan.
yeah, it
Thank you,
winds up
sir.
being, well, it winds up being compelling. Like, nobody likes somebody to just kind of tell a general story. Like, you're always very specific. You know, you always have all your data and your ducks in a row, and it winds up being this very sort of detailed thing, but you kind of unravel it for people in a pretty good way. I think I feel like I just described what all our subscribers respond to over the years. You know, they don't want a guru. They want someone who's got real skill as an analyst and a real strategy, who really knows what they're doing. It's like the old days of trying to be a guru in the newsletter business are gone forever. Thank God. Thank God. You know, so I'm really lucky and I think we're both really lucky at Stansberry to just be surrounded by evidence of this trend, you know, because there's
Yeah.
just like one great analyst after another, and we've had many of them on the show.
Well, I mean, you have to have an alternative. Wall Street right now, I think I just ran this analysis 3 months ago. Wall Street is still 92% buys, line by line. 92% buy recommendations, right? And only like 6%, sorry, buy and hold. 92% buy and hold, and only 6% sell. I'm like, on what planet could that possibly be correct?
Yeah.
Right. And that's across, if you take all the bulge bracket, that's Goldman and UBS and JP Morgan, everything else, and put it all together, they're all the same, right? 90+%. Because the real client is not us or you, the investor. The real client is the corporation, and they want to keep the corporation happy. So they always give these glowing things that even if things are bad, oh no, the company's going to work around it and navigate it. And that's why I've got a buy or a hold. Buy or a hold often, I mean, over and over and over again. In fact, if I said just buy, so take out the holds, buys are still outrunning sells by 7-1 or 8-1 in terms of recommendations by Wall Street across the board. So yeah, I mean, Dan, the reason why you have an audience, why we have an audience, why I think some of our fellow, authors and editors are doing well is because, we're not beholden to this, bias of, oh, I better not say anything bad about the company, right? Or S&P, Moody's, and Fitch, same thing. Who pays for a credit rating? Dan, you can get a credit rating on any company right now. When's the last time you paid for it? Because under John Moody, you had to pay for a subscription.
Yeah.
John Moody said specifically, I will never take money from the issuer because the bias, he goes, he quoted a slippery slope. He goes, there'll be no turning back. Well, who pays for credit ratings today? John Moody will be turning over his grave.
Yeah.
The issuer. GM pays for GM's credit rating. How can you not have bias?
Yeah.
Right? And so when we build and this credit strategy, what's different is you really are seeing something very different than if you went to the big three agencies or, anything by Wall Street.
Right.
And
except for Sean Egan, right?
What makes it, what's that?
Except for Sean Egan Jones.
There's some good independents out there, but
yeah,
there's some good independents out there, but
they're small.
Yeah, there's a few.
Yeah, I've enjoyed Sean's presentations over the years. He's been at Grant's once or twice.
Yeah.
And I'll never forget when it was a while ago when two of the big home builders were merging, and he said he called it two drunks holding each other up. I've used that line many times since. When I see a bad merger, it's two drunks holding each other up. I got that from Sean Egan, who is an independent credit rate. Like, investors pay him, not companies. So
yes, right. That's John Moody. John Moody originally was, hey, I need the investors to pay me, and it has to be subscription so that I give unbiased, say what I think. I might be wrong. I might make a mistake, but I'm making the mistake from an unbiased standpoint versus clear mistakes by Wall Street and the big three that have a lot to do with who's paying the bills. Right. It's unfortunate.
This is a big issue because, like, this credit rating, it's a utility function in the market. It's something that a lot of people rely on. And
a lot of the general public, but not my clients. My institutional clients,
Joel's
the biggest
clients
in the world. No, I mean, and I'm saying the biggest investors in the world will walk in there and we'll say, what do you think? And they're like, yeah, we only use the ratings for compliance. We're compliant to show here's what we're buying, here are the bonds we're buying, and here's the rating from one of the big official NRSROs, right? Nationally recognized statistical rating organization, which, by the way, is another regulated monopoly, meaning regulatory capture. Coming back to that, George Stigler talked about the difficulty of us. If we wanted to become an NRSRO, the hoops are massive. The cost is enormous, right? Regulations favor the incumbent. They favor monopolies. They kill competition. And it makes it very, very, very hard for someone like us to say, we'll be a nationally recognized rating organization. It's just because the regulatory capture is in, right? It is. It's in.
Joel, you're sounding more like me every second. I've talked about this in all kinds, and it's true, and it's especially in finance, right? Who's always on the front lines of wanting more banking regulation? Well, J.P. Morgan, Bank of America, all the largest incumbents. They want that expensive hurdle for the competition to have to get over, and it goes in every
And it
industry.
leads to consolidation, and it leads to fewer players, and it's worse for the consumer and society as a whole. But man, do those commercial interests get the benefit of not having to work as hard as they used to get people to buy their product, right?
Right.
Now, now, Dan, where we differ, right, is and it's not a big difference, but it's a difference. Is we are running, right, a global research house, right? We're running credit and credit analysis and equity analysis on 32,000 companies.
Mm-hmm.
And what I can tell you that as bad as these things are in the US, it's a comparative advantage because it's far worse in pretty much every other country in the world, with the exception of maybe some tiny little country that has adopted US-like Bill of Rights or a US-like constitution. But other than that, you go around the world, it's so much worse, which is why people are like, well, if you're so down on these things that are happening in the US, I'm like, yeah, but it's 10 times worse in China. Right? It's 20 times worse in Russia. It's 50 times worse in the Middle East, right? Where you really don't have any level of this thing. And regulatory capture is 100%, not 10% or 20% of what's going in the industry, but 100%. And because of that, that's one of the reasons we're still bullish on the US. So for all its faults, it's a lot worse elsewhere. And we could say that, with data, right? With evidence that China's in deep trouble. By the way, China's lost for 40 years. This idea that a post-zero pandemic, zero tolerance, pandemic COVID thing is going to result in a boom in China. We were very big, if you remember last year at Stansberry Vegas conference, and people were saying, oh, China's going to come back. They're going to open up. And we're like, nah, this is out of the frying pan and into the fire. They're getting out of the pandemic issues, and they're going back in the horrible credit issues. So while I am concerned about U.S. credit issues, and we'll talk about that on our program Wednesday, China is a lot worse. What China's going through right now is worse than 1929 U.S.
Whoa.
Worse than that, right? Worse than
19,
bankers jumping off of buildings. It's atrocious, and we've got the data to show it. And the problem is the big three don't have that data. They're not running credit ratings on every company with debt. They're running it on clients. We're running on every company with debt because our clients, the subscribers, ask for it. And that does give us some insights about, yes, I think the U.S. is going to have a tough 2 years. China is going to have a tough 20. Russia is going to have a tough, well, maybe forever. I think we've seen really the end of the Russian Federation as we've known it. And it's partly because of these issues that aren't just military oriented. They're how are they funding and financing their businesses, and what do they do without foreign direct investment? It destroys, these economies can't survive as islands. And the more they're either forced to become islands or choose to become islands, they can't survive, right? The U.S. can replace a lot of what happens in China with Mexico. China cannot replace the U.S. consumer with anyone else, right? Mm-hmm. The U.S. can get by without China. I'm not saying it's pretty. China can't get by without U.S. as a consumer. And they're going to an unbelievable, terrible leverage issue. So, no, I'm very, very bullish on the U.S. 10, 20 years out. It's just going to be a really rocky and tough couple of years.
Yeah, I'm afraid it'll be a rough sort of sideways several years, but that's for me a possibility, not a probability.
No, yeah, I think hard for me to say. Is it 1 year? Is it 3 years or more? You heard me say if you need the money in 5 years, your money cannot be in U.S. stocks. Well, frankly, any stock market really. It could be in some individual names. Don't get me wrong. I think we're still picking individual names. It could be an AI related. It could be supply chain related. It could be particular healthcare medical things that we're like, no, this is still going to do well no matter what. So we can still be active stock pickers, but you can't passively put your money in the U.S. stock market. If you need that money in the 5 years, you have to be active.
Yeah, I saw a chart of the Russell 2000 equal weight, and I thought, well, it's only 7% of the market cap, but it's 2/3 of the names, and it's down for the year. I mean, the Magnificent Seven have propelled the, S&P and NASDAQ up, whatever, 20, 25% or whatever that, or no, at this point, actually, it's quite a bit less, isn't it? But I was just looking at a chart here, but it's not on my screen. And, so the big indexes look like they're doing fine, double-digit returns or whatever, but most of the market is down for the year, which, it just makes me wonder, like, when am I going to see the other shoe drop? When is the rest of the market going to sort of fall in line? And I think, I don't know, you're pointing to some of the issues, and I've pointed to similar issues, and next year doesn't look so great. So we've reached a point where it's time for my final question, which is the same for every guest, no matter what the topic. You've answered it before. I hope you don't remember it, because it works better if you don't know what it is.
I don't.
Okay, good. So
I just enjoy our conversation, so I don't feel it. But
all right,
yeah,
so
shoot.
Besides going to crashalert2023.com and signing up for your presentation next week, if you could leave our listener with one thought, one idea today, what would it be?
I have never been, and I say never, when you look at the long-term data, I have never been so bullish about long-term U.S. economy and U.S. equities. Long-term.
Mm-hmm.
And at the same time, I've never been so bearish about U.S. equities in the short term, with the exception of maybe 2008. With the exception of maybe early 2008 in that CFA conference, where I should just show some scary signals. But the signals now are getting there. So yeah, it's long term still super bullish about U.S. and U.S. equities and U.S. economy. Short term, and by short term, as we've discussed, that could be 1 year, that could be 3 years. I'd be deeply concerned about any passive investments in U.S. equities.
All right. You heard it here first. If you want to hear all the details of that, go to crashalert2023.com and sign up for Joel's presentation. Joel, thanks again. It's always a pleasure to talk to you, man. I feel like we just don't get to talk enough.
Thank you, Dan. Well, and I'll be seeing you. I'll be seeing you in Vegas, right, for the big conference.
Yep, we'll be there.
Well, maybe we'll be able to break bread there.
Yes, we will. All right. Thanks
Awesome.
again, Joel.
Thank you, Dan. Much appreciated.
Folks, stocks are near all-time highs. AI has added trillions to just a handful of stocks, and everyone's convinced the market can just shrug off the biggest and fastest interest rate hikes in history. It's textbook bubble behavior, and it's why my colleague Joel Litman is stepping forward with the biggest warning of his career. Now, Joel warned of the coming disaster in 2008. He nailed the market bottom in 2020 and the top in 2022, both nearly to the day. Now, he says he's more worried about stocks than he's been in the last 16 years. The next crash is underway for a specific reason that almost no one is paying attention to. He's issuing a rare recommendation to put nearly everything into a completely different approach, the one that the rich have used to make a fortune in every crisis for decades. It's not gold or anything else you've likely considered, but Joel's used it to show his deep-pocketed professional clients an 87% win rate with gains above 100%. And in the coming crisis, it could show you double-digit income and hundreds of percent gains over and over. I urge you to tune in and hear Joel's stunning warning, along with one of the greatest market secrets you can ever learn. Just head over to www.crashalert2023.com for full details. Joel will go live on Wednesday, September 27th with all the critical details. You do not want to miss this. Head to www.crashalert2023.com right now to make sure you're on their list for updates. Again, that's www.crashalert2023.com. It's 100% free. Well, listening to Joel Litman talk is always a great pleasure for me because obviously he knows an awful lot about an awful lot of companies, and from a perspective that we don't often hear. We hear a lot of analysts and investors and traders on the show, but we don't talk with a lot of accountants who focus solely on accounting, and Joel is exactly that. And he works with, oh gosh, I don't know. He's worked with the U.S. government, with the Department of Defense, and all kinds of the U.S. Marines War College, and just all these huge investors. The top 240 or so, as he was mentioning, investors, institutional investors. So, he's got a fantastic perspective on things, and he's made a lot of good calls. He's been bullish at the right times, and I've been sort of consistently bearish, but he's called the bull runs in the past couple of years that I won't say I've missed them, because I've been recommending long stocks that have done very well in the past couple of years, but I've continued to warn about what I think is going to be a sideways market, that you heard Joel mention that too, and what I'm afraid is going to be kind of a crash in the next 6 to 12 months here. And I started saying that in March, April, in my newsletter, the Ferris Report, that I thought a really sudden crash, with the market down 20-30% in a big hurry. I thought there was an imminent danger of that. I still think it's imminent. Hasn't happened yet, but the action recently has been not great. And Joel is starting to see the same things. Before we hit the record button on this podcast, he says, Dan, I'm starting to coming around to your way of thinking, at least in the short term. So I hope you take all these warnings seriously, because they don't just come from me. They come from people like Joel, who I do a lot of my own type of work, but I don't do, like, Joel and I overlap on some viewpoints, but the type of work he does is completely different. He's focused primarily, almost solely, on accounting issues and finding good stock picks by knowing the accounting issues very well. Whereas I sort of build some of that into my analysis, but I don't focus solely on that. It's really great to hear someone like that talk. It's really valuable to you. If you don't think so, go through, listen to the podcast again. I'm not kidding. It's that important. And whatever you do, go to crashalert2023.com and sign up for the presentation. The guy's a genius. He'll teach you all kinds of stuff I promise you don't know. crashalert2023.com, and sign up for the presentation and view the presentation. All right. Well, that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com, please. And also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com, or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, until next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, You should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.